In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion.
And good afternoon once again, Market Rebels, from a very windy, wet, rainy South Florida. Stu, what's going on up on your end?
I can tell you that it's not windy and wet. We don't have a hurricane here.
Is it snowing yet?
Not yet, but
it's snowing yet. All right. Well, hopefully, I've been saying this the last few weeks. Hopefully, I'm going to survive through keeping the power up and running here. So if I kind of just mysteriously vanish, you're going to have to take over till I log back in. But today we wanted to bring to you, we've had a few questions about this from traders. Very interesting topic, and people usually find out about it the hard way when they suddenly get a restricted account and can't trade in their own account except for closing orders. So what in the world are we talking about, and how can you prevent that? So what we're talking about here is the pattern day trader rules, how to survive them. Now, we're not talking about how to break them or something illegal, but part of what we're trying to show is that options are super powerful and versatile, and if you understand how to use them, a lot of times they can help to solve problems that some people will say just cannot be solved. So let's talk a little bit about the pattern day trader rules. What is it? How do they work? How can you get stuck? And then we're going to talk about how you can survive them. A couple of neat little tricks. So let's start off with a Chalk Talk question. So for anybody who's new, we like to kick off our webinars with a little thought-provoking question that we'll come back and answer at the end of the presentation. But in the meantime, kind of think about this. So you bought shares for $100 as a long-term hold, right? So that's your outlook. You're going to hold these things for years and years. But on that same day, you place a stop order at 99, so $1 below. And unfortunately, the order is triggered that same day. So you've bought it and you've sold it in the same day. The question is it considered a day trade? Were you a day trader? So something to think about. We'll come back. We'll actually answer this during the presentation, but we'll do a recap of it at the very end.
Does it count if I didn't mean to be a day trader?
Well, we're going to find out. That's what a lot of people think. That's why I put this up here. Your intention was to be a long-term hold.
These are the facts, people. This is what we have to deal with.
That's right. So this whole thing starts with FINRA, and FINRA is the Financial Industry Regulatory Authority. It was formerly the NASD, National Association of Security Dealers. So they're kind of our, what would you call them, Stu, our financial watchdog?
I would say they're the police.
Yeah, they're kind of the police. Now, actually what they're called is an SRO, a self-regulatory organization. And a lot of industries do this because the last thing you really want is the SEC breathing down your back. The SEC is ultimately the biggest guard dog. So what they do is they say, all right, let's form our own police force. and let's just make sure that we keep ourselves squeaky clean so the SEC doesn't ever have to step in.
Right.
And that's called an SRO, and that's technically what the NASD was, and then it rolled into FINRA.
Yeah, they're the watchdog. They're watching.
Yeah, just exactly, kind of our watchdog for the industry. So in 1974, they established that you had to have a $2,000 minimum equity for a margin account, and that is still true to this day. You can have a margin account with only $1,000 in it, but you wouldn't be able to place a trade on margin. It would have to be fully paid for until you hit that 2,000 minimum equity threshold. Well, that's not really a big threshold, but things changed after the 2000 crash. And FINRA added what's called the Pattern Day Trader Rule, usually abbreviated PDT, the following year in 2001. So why did they do this? Well, the idea was to protect brokers and markets, and theoretically the traders themselves, by requiring higher balances when engaged in day trading. Now, obviously, there's a lot of controversy over this, and I see both sides of it. I think their intentions were good, but one thing I can see, Stu, let's say if you really believe that something is going to come crashing down, and the best move is to exit the trade, but you say, well, I don't want to exit it because FINRA is going to ding me with this pattern day trader mark against me, so let me hold on to it, and you end up putting yourself into a worse position. So there's always two sides to the story, and I'm not saying that this is the best way to approach it or handle it, but as Stu said, we have to trade the markets that we're given.
No, I got a quick question.
Sure.
So if I have used all my bullets, say,
Mm-hmm.
and I go to make a trade that would be the fourth bullet, but I've used all of them that I'm allotted, would the broker allow me to actually execute that trade, or would it stop me from executing?
Would absolutely stop you unless you have 25K.
Yeah, assuming you're under. So you wouldn't even be able to. So
you could do closing orders. You would not be able to do an opening order.
Would not be able to do it. Okay, got it.
We're going to talk about some of the specifics here in a moment. But yeah, good questions. But that's part of why we want to present this, is because a lot of people get stuck with this and they go, well, I didn't even know about this. Mm-hmm. So we want to bring it to your attention. Part of the advantage of having a coach, right? So let's start off with which trades count. Well, the basic rules say that any day trade counts, which simply means that you opened and closed on the same day. So you could buy a call, sell a call, or you could sell a call and buy a call. It's just about entering and exiting on the same day.
Same one.
The same ticker, correct, or the same opera code for options.
Same.
But if you wait till even the opening bell the next day, then all bets are off, no longer a day trade. It's just got to be in that same day.
But of course you have that overnight risk.
Oh, of course. Yeah, you do. But that's what I'm saying is it's not necessarily a super long period of time where this now becomes negated. It just the next opening on that next business day is now fair game. So we're just talking about the same day. So this applies to stocks, options, ETFs, exchange traded funds, or ETNs, exchange traded notes. Anything that trades like a stock, options, anything that you're probably used to trading, it applies to. Now, interestingly, a lot of people don't know this. I know you know it, Stu, but futures and Forex don't count.
You can
trade futures contracts, you can trade Forex or foreign exchange currencies, for US dollar, Japanese yen, all that kind of stuff.
Yep.
Trade that to your heart's content, in and out 1,000,000 times a day. It's not going to count.
And
the reason is they are regulated by the National Futures Association, or the NFA. But part of our answer here, stop orders do count. So again, it doesn't even matter if your intention is to buy Microsoft for a 10-year hold. If you put a stop order and you get triggered out that same day, as Stu said, you've used up one of your bullets. We're going to talk about that in a moment. But part of the thing to take from this is that if you don't want to have this fear of day trades counting against you, and the fear would be that you don't have the 25K to put into your account. If you do, day trade to your heart's content. It's nothing illegal about it, immoral about it. It's just that the NASD or the FINRA is going to require that you've got 25K.
And by the way,
So-
they may still, even if you have over 25K, they may still tag you as a pattern day trader,
Oh, they definitely will.
but
Yeah.
there won't be any consequences to it.
Correct. Right.
It doesn't mean anything.
It doesn't mean a single thing.
Right.
So if you're one of these people who are thinking I don't have 25K in there, or it would be a struggle to get it up there, you need to understand these rules and then also some of the ways to keep yourself afloat, which is what we're mostly talking about here. Now, here's a screenshot, Stu, from all of the traders who are on Thinkorswim. It says right there, day trades left. Shows you right there on the account info screen. And so E-Trade does it. They don't show it on the platform. They do it on the online version, but your brokers somewhere will keep tabs of how many day trades you have left.
So if
this
I bought and sold the same contract in the same day, that would go down to 2, and then
I'd go down to 2.
sold another contract, it would go down to 1, and if I did it again, it would go down to 0, and then the fourth time, I'm out of luck, right?
Bang.
You're done.
You're now labeled PDT. And as you said, if you've got over 25K, it's a moot point. Doesn't mean a single thing. It's just that label's on your account. But again, who cares? It only becomes important if you don't have the 25K, and more importantly, can't bring it up to that.
And
So let's-
incidentally, look, you can stand on your head and argue back and forth whether it's the right thing or the right thing. Like Bill said, he could see both sides of it. It doesn't really matter. It is what it is, and
It is what it is.
And these are the rules that we have to live by.
That's
And
right.
move on.
But there are ways that you can survive in a better fashion by understanding options.
Mhm.
So that's what we're going to talk a little bit about. And before we do, as always, please check us out, marketrebellion.com/get started, especially if you are new. A lot of great videos, tutorials, articles on there to give you a good, firm foundation with options, theory, strategy, pricing principles, things you really need to know to really master the markets. A lot of bad information out there in the market, so check it out, all free stuff. So the pattern day trader rule, what exactly is it? Well, again, it applies only to margin accounts. And what it says is that if you have 4 or more day trades in a 5 business day period, so it's a rolling window, like a moving average, 4 or more day trades in a 5 business day period, you're considered a pattern day trader. Now, there is an exception, always an exception, right, Stu?
Oh, yeah.
The exception is if the day trades are 6% or less of the total trades during that same 5-day period,
Which is really low.
which is pretty low.
If this is the kind of trading that you're doing, you're going to be way over that.
Oh, yeah. Yeah, you're most likely going to be well over it. But they do give you that out to say that if you're putting in a whole bunch of trades that never fired off in the same day and you've got 6% or fewer that did, they'll say, all right, well, that's such a small amount, we're not going to really count that against you.
Yeah.
So that's an exception. However, as I mentioned, if you are labeled with a PDT tag, you must have 25,000 equity. Now, also remember, brokers can always make any rule stricter. They can't relax them, but they can make them stricter. They might say if you have 3 or more in a 5-day period, that's fine. That's making it stricter. They can't say, we'll give you 10. That's making it more relaxed. So
And
always check.
That 25K is that's a rolling number as well. At any time during the day, if you dip below that 25,
You got to maintain it. Yep.
you got a problem.
Yep. Now, it might be easy to get out of, and we'll show you how to do it. But yes, you have to maintain that 25K. Now, there is an alternate reason for being labeled a pattern day trader. What is that? Well, if the broker has a reasonable belief, of course, up to each person to figure out what's reasonable. But if the broker has a reasonable belief that you'll be engaged in day trading, they can automatically label your account as a pattern day trader. So for instance, let's say that you open up a brand new account at Thinkorswim or E-Trade, and they say, what's the reason for the account? Some people will say, oh, it's for long-term investing, it's for my kids' college, but they might say, Oh, I'm following Joe's day trading newsletter. Well, you kind of told them off the bat that you're probably engaged in day trading. So they don't have to wait for that to happen. They're just going to say, we have a pretty good reason to believe that this person's going to be involved in day trading, and bang, right off the bat, before you've even funded the account, they've got you labeled as a pattern day trader.
Hate that.
I hate it when that happens. But there are always benefits as well. What are some of the benefits? Well, a pattern day trader account may trade 4 times what's called the maintenance margin excess, your excess cash available. We've talked about that in some of our margins classes, as of the close of the previous day. Now, normally you get 2x, but if you are a pattern day trader, you get 4x, but that's only for the trading day. Now, if your equity falls below 25K, you get what's called a restricted account, and you're back to 2x. So this is what Stu was talking about. Even if it's down at 24 or 24.5, you're below 25K. So does that mean that you're out of business and can't trade anymore? Not really. You have to be able to meet it, though. So what's going to happen is you will be issued a day trading margin call. Same idea as a Fed call or a margin call, but they're a little more relaxed here. They don't technically have to be met by close of business. And you can, of course, deposit cash or securities just like you can with a regular margin call. But you have 5 business days to meet this type of a margin call. Keep in mind, very important, this is not for all margin calls. This is just for a pattern day trader margin call. 5 business days to meet. Also, interestingly, cross guarantees aren't allowed. So what in the world is a cross guarantee? A cross guarantee is when you are making the guarantee of this 25K across, let's say, a different account. So you say, all right, yeah, my regular trading account doesn't have it, but if you look at my joint account, even if it's with the same broker,
Or my
you say,
IRA.
Mr. Broker, yeah, you say, go look it up right now. And they say, yep, I see it here. You're right. Got $1 million in it. Does not matter.
Right. Even the
It's
same
got to
broker.
be,
Important.
right. Even if it's with the same broker, got to be in the same account.
Mhm.
Now, you can withdraw the money after 2 business days. So you talk about gaming the system. I think what they really want to do is to see that you have the financial wherewithal to say, I could make that $2,000 deposit or that $5,000 deposit if
Yeah.
I needed to,
If you needed to. Yeah.
or the $22,000 deposit if I needed to. They just want to see that you have the ability to do it. So in a way, it's not really required unless you want to continue to day trade. Now, if it's not met, then the account is restricted to trading on a cash basis only for 90 days or until met. Now, you can do closing transactions, but this is part of the thing where you might have this really brilliant trading plan. It's all unfolding exactly as you wanted. And part of the plan was maybe to scale into a position, and you're like, oh, this is a great time to do it. And guess what? Plan's foiled. Can't do it. Will not let you do it. And yet this is where traders are going, what happened? I don't understand. How come I can't trade? I've never heard of this rule. This is why you have to understand the rules and how to potentially avoid them.
Yeah. Suppose you kind of fell into this trap and
Mm-hmm.
something happened in the market, and Nvidia opened at 90 from
Yep.
100 or wherever it was that day, and you had as part of your plan that you wanted to buy whatever call that was, or the stock for that matter.
Yep.
You can't.
Can't do it.
You're out. You're
You
sitting
are
on the
done.
sidelines.
Yep. And that can really throw a wrench into the trading plans.
Yeah.
So let's talk a little bit about it. How can you avoid this? All right. So how can you avoid? One thing is, remember, futures don't count. You could trade something like the E-minis. It's a 1/5 contract, 50 multiplier instead of 250 for the S&P 500 for the big contract, as they call it. So these have very low margin requirements. You can trade in and out of those all day long, and you'll never have a pattern day trader problem just because they're regulated by the NFA. What else can we do? Well, this is a little trading trick here. What you can do is you can trade the following expiration. I'm just going to call it generically expiration plus one. So if you have a January call that you want to trade, you could trade February. If you have a 1 week option that you want to trade, you could trade that second week, that extended weekly. Or in some cases, could even do it in a matter of days. You're just trying to trade something a little bit longer than you would normally trade.
Yeah.
But close. Keep it as close as you can. You'll see why in a moment.
Close.
So let's say that you trade, in other words, again, trade the week 2 contract instead of week 1. Now, if you want to close in the same day, but you're going, I don't want to use one of my bullets for a pattern day trader, or maybe this is going to be the 5th one that's going to force me to put 25K into the account, what you can do is to sell the shorter term same strike option. And this is what we would say is legging into a calendar spread. So recall what a calendar spread is. That's where you're going to buy a longer term and sell a shorter term with the same strike. So if you buy a February 100 call and sell a January 100 call, or buy a March 100 and sell January, you're buying a longer dated one, selling a shorter dated one with the same strike. That's a calendar spread. And the reason you want to try to keep these expirations fairly close is that your Greeks will be nearly identical.
Yeah, that's the key.
That's really the key.
You're just looking to offset
the risk.
Offset the risk of the option that you
own. Right.
You go either way, long or short, with something that is relatively identical, not exactly identical, but relatively identical. And you could even go the other way, right? Maybe you're long the front term and maybe you sell the next one. It could be short the times, right? It doesn't really matter. You're just looking to offset. The point is you're looking to offset the risk with something that looks and feels and smells and tastes very similar to the position that you have.
Right.
But and Bill's going to explain this. There is a dynamic here that you really have to have the discipline to do. So go ahead, Bill.
Yeah. So again, the thing is, if that's hard to see, imagine that if you have a 7-day call, and if there were an 8-day call, same strike. Is there really a big difference between those two?
No.
Do you think the deltas are going to be radically different, or the thetas are going to be radically different? They're just not, because the time between the two contracts is so small. That's why it's important to keep, when we said going out to this expiration plus one, you don't say, well, I want to trade this weekly. Let me go buy a leaps option instead. Well, now forget about it. That's not going to work. You got to keep it reasonably close.
Yeah.
The closer, the better. So what we're saying is that they're basically the same contract, but they're different tickers.
Yeah.
Or what are called opera codes. And because of that, FINRA is not going to tag you with a closing transaction.
Right. It has to be the same. In order to be the pattern day trade, it has to be the same exact option.
Yep. Got to be the same. So let's go find out how that's going to work. And as always, before we do, quick reminder, marketrebellion.com/get started. All kinds of great materials to help you on your way to understanding how to master the markets by knowing your options. So let's look at an example here, Stu. Let's say that the 1 week $100 call, according to a pricing model, is $1.66.
Okay.
The 2 week option, according to that same pricing model, is $2.34. So yeah, you might have wanted to do the 1 week. You might have wanted to pay $1.66. But part of the cost, if you want to avoid this pattern day trader rule, or at least using one of your bullets, is to pay $2.34. So you got to pay another 68 cents. So there is a little bit of a cost here.
Bill,
let's say
I can't help going off on a small sidebar here for 30 seconds. I just can't control myself. If you take a look at that 1 week call versus a 2 week call, that is double the time. However, it is not double the price.
That's right.
That's a lesson in and of itself that you, as a proficient options trader, you absolutely must understand. And this comes under the topic of the square rate pricing. This is something that is prevalent across the universe of options.
That's right.
And you have to understand this, which has nothing to do with the pattern day trading thing. I just couldn't control myself. I had to throw that in. So go ahead. Sorry.
Well, it's a good point, because what we're showing is that, yes, you have to pay more, but it's not going to be a lot more. And if it's going to help you to achieve your goals without having to worry about pattern day trader rules, it's a pretty small price to pay. So now let's say that the stock rises to 103 in the same day. If it were a later day, it wouldn't matter. You could certainly close out the one that you're long. But let's say that the stock rises to 103.
Yeah.
Now, according to the pricing model, the 1 week $100 call would be trading for 359. And had you been able to buy that, and had you closed it here, that would be a $1.93 gain. And we're just putting it in here as a reference point. However, the 2 week call is trading for 417, so that would be a $1.83. If you close this, of course, you're still going to get hit with a day trade. But you can see that there's only about a 10-cent difference between them. Again, not a real big difference.
Immaterial.
But what we're going to do so we don't use up one of our bullets, we're going to remember we own the 2 week $100 call. We're going to sell the 1 week $100 call, which remember is trading for 359
to offset the long of the 2 week call.
The 2 week. So we have legged into a calendar spread. We own the 2 week. We've sold the 1 week, same strike. That is a long calendar. But take a look at the prices here. We spent $234 and we collected $359. So we have a $1.25 guaranteed locked up. Now, is it as good as a $1.83? No, but it's remember, this is also the minimum. You're going to find out that we could also get close, but this is part of the cost. Now, if the stock doesn't make a terribly big move up or down, we will probably get close to a $1.83. We might even be able to squeeze out a little bit more.
You might.
So
one of the, maybe the theta kicked in, you made a little money on the theta. Remember, now in order to really understand this, you got to understand the theory behind a calendar spread, which is going to make the most money at the strike.
That's right.
That's why Bill said if it starts to move away, you might have to give up a little bit.
Right.
But if you're in the same vicinity, in the same neighborhood, on the same street, not necessarily the same house, but in the same street as where you were yesterday on the close, then you're kind of right where you ended up, and you've now alleviated the problem of having to use a bullet to get out of your risk. You covered your risk overnight, and now you have to go ahead and execute to get out of that risk, right? You don't want to really carry, I don't think you really want to carry the calendar spread.
No, that's not the intent.
The intent is to just alleviate the risk of the overnight.
Correct.
On the bell, you want to unwind it and just
unwind it. Yep. So here's what it looks like graphically. All right. Because so when you bought
remember, you wanted to get out of it anyway. That was your intention, right? You wanted to get out of it, but you couldn't. You just
don't want to do it in the same day.
And you're now taking care of the risk on, because of the time that you have to wait. You don't want to do that. So you found a way to kind of hold the fort steady, so to speak, and then get out of it the following morning.
Right. So here's what it looks like graphically. Here's the $100 call when we bought the 2 week. All right. So remember, we wanted to do the 1 week, but just as a little protection here, we go out to the next expiration reasonably close. This is what's called our current curve. All right. So now the stock goes to 103 the same day. And if we were to close the 2 week $100 call, we would be flat up here at a $1.83. That's what we saw before. That flat line just means no matter where the stock goes, we've got a guaranteed $1.83 profit. But if we sell the 1 week $100 call, what do you suppose that black line looks like, Stu? And for everybody out there, remember, they're reasonably close.
Yeah, it's going to be pretty much the same.
It should be pretty close to that black line. So according to a pricing model, that's what we get. So you can see that if the stock is like Stu said, if you're on the same street, not the same house, though the black and red lines are about the same. In fact, the red line sits a little bit higher than the black. We might come out a tiny bit better. Nothing to write home about.
Remember, that wasn't your goal. You're not looking.
That wasn't your goal. But if the stock makes a monster move, now we've at least got that $1.25. And that's doesn't show it here, but if we went further out, they would sink back down to about a $1.25, which was the minimum. That was the difference between the debit and the credit.
Yeah, because remember, as they both move like way in the money, they both go to parity and
Yep,
then
collapse.
collapses. And as they both go to zero, they both go to zero and the spread again collapses.
It just, yep, exactly. So it's only going to widen when it's in the center, which is, but as Stu said, that's not really the purpose of putting this on. We don't really want to trade the calendar. We're just trying to bide our time till we get to the next opening bell, so that we don't use one of our PDT bullets, let's call them.
Just so FINRA doesn't, the police don't come knocking
Say
on
we're
the
gonna charge you for a. Now remember, if it is a day trade and you're not really much of a day trader, put it in. You're fine. You've got 4 and a 5 business day period. So it's not saying that you have to use this technique.
No,
It's just if maybe this is number 5 and you don't have the 25K, consider this. We're just trying to show you that there are ways to alleviate some of the problems and risks by understanding options. So this is a very cool technique.
And having some, a little bit, maybe it's early in the morning and you think you might have 3 or 4 trades that day. Maybe you want to consider saving a bullet by using this.
Absolutely. So that's the way you can do it. We just thought that would be interesting to pass along to our traders out there for Coach's Corner. So let's go and visit our Chalk Talk, which we did answer, but see if you're paying attention. So you bought shares for 100. Your mentality was a long-term hold, but you place a stop the same day, and you get triggered out. Is it considered a day trade? And the answer is absolutely yes. And that's where a lot of traders get pegged. They might have said, well, I've done 3 day trades here, so let me back off the day trades until I roll out of this. And they put 2 stop orders on things that they're thinking are going to be long-term. Bang, you get the market that turns around and suddenly you're labeled as a pattern day trader. And now your hands are tied.
Now you got that 90-day thing. And
now you got the 90-day thing if you can't cover. Exactly.
Yeah.
So anyway, we just thought that would be another interesting little kind of angle that professional traders are all very familiar with, that most retail traders are not. And that's some of the things that we tried to bring you here on Coach's Corner to help you make better use of options. So I hope that helps. Stu, thanks so much. I'm glad that I made it through here through the wind and the rain. And we hope that you enjoyed it. And we will see you next week, 4 p.m. Eastern on Thursday for the next Coach's Corner. We'll see you then.
See ya.